Well, India has tightened exports of oil and imports of gold in an all-out effort to rein in the plunging rupee. The government raised import taxes on gold to 12.5% from 7.5%, while increasing levies on exports of gasoline and diesel as it sought to control a fast-widening trade deficit. The measures sent shares of the country's energy exporters, such as Reliance Industries, tumbling, and the rupee fell again to a fresh record today. The currency has fallen 6% this year against the dollar, which has been strengthening from interest rate hikes. And the moves underscore the challenges faced by Prime Minister Narendra Modi's government. As for the broader fuel market, taxing India's petroleum exports may further tighten supplies when other emerging markets are already facing shortages. And for more, we are joined by Rebecca Bundan from Mumbai. And Rebecca is now, of course, we're going to speak to us more about this issue. So, Rebecca, how will these taxes affect the rupee and costs of living?
Well, if we look at the factors behind these moves, the fact is that India is a huge importer of oil and gold, and this is very costly for the economy, particularly given as commodity prices have risen and India has been importing more gold in the past couple of months. Now, that actually widens the country's current account deficit, the trade deficit, and all this has been weighing on the Indian rupee as well, which we've seen falling to a series of record lows. And that's due to other factors as well, including foreign investors pulling out funds from Indian equity markets as there's been global liquidity tightening. Now, the rupee at this point in time is uncomfortably weak, given the fact that India has high inflation levels already, and a weak rupee actually increases the imported inflation, actually pushes prices up even more. And this weakening of the rupee comes even though the Reserve Bank of India, the central bank, has actually been stepping in to try to support the rupee. So this has been getting out of control a bit. The government has now stepped in with these moves. That import duty hike on gold, which has been raised from 7.5% to 12.5%. That's in an effort to try to reduce the amount of gold being bought from abroad coming into the country. And in terms of fuel, it's hiked the export duty rates in order to try to keep petrol and diesel within the country. Now, all this is actually aimed at trying to support the Indian rupee and try to keep inflation under control, although it will, of course, it does mean that gold prices will rise for the Indian population. That will be more expensive. But on the other hand, the idea is actually to keep the rupee under control and to keep inflation under control and try and keep rising prices within, like bring them within the comfort zone to actually help the Indian population.
Mm-hmm. In the meantime, there are also concerns that measures like these could undermine India's economic growth. So how will the government prevent that from happening?
We can see that there are some negative effects already if we look at the reaction on the stock markets of Indian fuel exporters, particularly Reliance Industries and ONGC. Those stocks actually tumbled as a result once this was announced. The same for jewelers as well. They'll be hit very hard by this, and we saw those stocks plunging as well because gold sales are expected to reduce as a direct result of this potentially. And this comes as the wedding season and the festival season are coming up in the coming months when people actually tend to buy a lot of gold in India. So on that hand, it's negative. But the Indian government's aim is really to try to support the economy with these moves because it wants to try to keep the trade deficit, the current account deficit under control. It wants to support the Indian rupee, which in turn will be good for the Indian economy, particularly as inflation levels have been very, very high in India. The Indian government wants to try and rein in inflation, and these steps are actually aimed at achieving that. There's also the fact if the Indian rupee continues to weaken the way it is, another way that the central bank can actually try and support the Indian rupee is through further interest rate hikes, and that's not necessarily supportive of economic growth because it makes it more expensive to borrow money for for consumers and businesses, which can be bad for the economy. So ultimately, the Indian government is thinking about the economic interests of the country, and these moves are aimed at trying to actually boost or support the economy.
Mm-hmm. Of course, we're waiting to see the effect of those measures. Rebecca, thank you so much indeed for your report. Rebecca Bundin from Mumbai.